Hi, John. Thank you very much for joining us today. How are things in London?
Well, we have had some fairly interesting developments on the political and economic front in the last few weeks. So I think it's probably fair to say it's volatile in London at the moment, both in terms of the currency, in terms of equity markets, and particularly in terms of government bonds.
And we're going to have a discussion on all of these events. So 2022, as you just alluded to, has been a brutal year for financial markets, and gold hasn't gone unscathed. Central banks started lifting interest rates in March, and they've acted rather aggressively since this time, and this has put a lot of pressure on gold, and I want to have a detailed discussion on this. But before we do that, why don't you just provide us with a brief overview of the World Gold Council? What is its mandate? And maybe you can also speak to the membership.
Sure. So we're a membership organization, as you alluded to, owned by some of the leading gold mining companies in the world. I think we've got about 31 members. It's difficult to keep count because they keep merging and buying each other. But it's all the names that you'd know from Canada, Australia, South Africa, and various other countries around the world. And we were set up about 35 years ago now to develop the gold market. So we're a market development association, really, for the gold market. And initially, we concentrated on jewelry demand because that was the biggest contributor to demand back then. And we've shifted slowly and then quite rapidly, I guess, over the last 10 years to be very much focused on investment. So we try and make gold more accessible to investors all around the world. And we do that in a number of ways. One thing that we believe is that for people to make investments in gold, they've got to have statistics and research reports and tools to analyze gold. Because if they don't have any of those things, then, well, how do you approach it? It's not like an equity or a bond. It is a different instrument. So I have a big research team that I work with at the World Gold Council. We produce lots of research, both on the fundamentals of supply and demand, but also on the investment drivers of gold as well. I say we have a very good website, which all of this information is available for free. We collect gold market data and make that available for free as well, particularly on the supply and demand side, but not only that. And then we also get involved in other things as well. ESG has become a big focus of ours because of the necessity of being able to talk about the ESG credentials of gold when you go and speak to certain investors. Similarly, we have a big focus on central banks. There's a team at the World Gold Council that exclusively talks to central banks, and we speak to about 94% of them, and the only ones we don't are sanctions, usually. And then we work sometimes with governments or regulators to try and open up the gold market, where there might be restrictions or unfair taxes on gold investment. We'll work to try and break those barriers down. And where necessary, we'll help develop infrastructure. So we're just completing a project now to get gold exchanges into India, which is a big part of modernizing the gold market that's going on at the moment. So we do lots of things. I'm primarily focused on the research and working very closely with our institutional relationship managers, so speaking to investors around the world and making the case why they should have gold in their portfolio.
John, I want to move on now and discuss the gold price and also the performance year to date. Gold started the year at $1,800 and it was up 10% on the year, but that all changed in the month of March when the Federal Reserve started increasing interest rates for the first time in 3 years, I might add, and they've raised a total of 5 times since then. The US dollar index is up 15% on the year. Gold is down approximately 8% on the year. This is much better than the S&P, which is down over 20% on the year. But I want to get a sense from you of what this move in interest rates and also the US dollar has done to gold flows, I guess, both in bullion and investments and also ETFs.
Sure. I mean, I think the way you described it in that question is very valid. Gold down about 8%, US dollar index up about 15%. So I just come back from marketing in Germany, attending a precious metals conference there run by one of the big refineries. And as I pointed out to them, yes, gold's down in dollar terms, but it's up in euro terms, it's up in yen terms, it's up a lot in sterling terms, and certain other currencies as well. So the biggest factor in the gold market this year, certainly in terms of determining the US dollar price, has been this remarkable strength of the US dollar. Now, the US isn't the only country to be hiking interest rates, but as I was describing to this bunch of German investors and fabricators, what's happening in the US is quite different from the other markets. The US is hiking rates because its economy is strong, and that strength in the economy is leading to inflation and very low unemployment, and the Federal Reserve has decided it needs to slow the economy down to get inflation under control. Fine, that sounds like a normal recession to me. You know, when the Fed kills every recovery by hiking interest rates. Great. But what's happening in the rest of the world is quite different. If you look at Europe, yes, rates have started to go up there, but they're not going up because the economy is strong. They're going up because inflation is high, and inflation is mostly high because of factors outside of the domestic economy's control. So we're talking about energy prices in Europe. We're talking about weakness in the global economy that's coming from, say, China and the real estate market there, which looks quite troubled at the moment. So this difference, the bifurcation really in the global economy, the US is strong, everywhere else is weak, and the US has been more enthusiastic in hiking interest rates than anybody else, has caused this remarkable strength of the US dollar. It's been a clear headwind for gold. Now, interest rate hikes also or hikes by the Fed, I should say, have been a factor too. But I think the biggest factor here is the impact that we're seeing on the US dollar. And that headwind looks set to continue, I think, for as long as the Fed is the most aggressive central bank on the planet, and for as long as it keeps increasing its forecasts of inflation, and of course its own central bank rates as well, the so-called dot plot. Now, that doesn't mean that the headwinds in gold will necessarily continue. I mean, I think even a hiking Fed is no bad thing, but it's just whilst they're ratcheting up their forecasts of inflation and interest rates, that's causing a headwind for gold, mainly through the channel of the US dollar.
So I understand the argument for gold being under pressure because of interest rates in the US dollar, but we've always heard that gold is something you own during times of trouble and during times of inflation. And with everything that's happening in the world with the war in Russia and the Ukraine, inflation at 40-year highs, why isn't gold doing better in this environment in spite of interest rates?
Sure. I'll rephrase that question in a slightly different way. When I speak to people that have followed the gold market and very closely over the last few decades, the question they come to me is, I said, why is gold holding up so well? If you look at a simple econometric model looking at the dollar and real US interest rates, which works generally very well in terms of explaining the moves in the gold price, then you would expect gold to be a lot lower than it has been. Now, to a certain extent, part of that was the Ukrainian war, or the Russian invasion of Ukraine, which did see gold strong in the first quarter. But I think most of that premium's probably come out of it now. I'm not saying the war's gone away, but it doesn't seem to be a shock to the market. Now you wake up every morning and you see what's happening overnight. It's not fresh news. So that's one factor. We did see decent investor and speculative activity as well around that time of the Russian invasion. We saw inflows into the ETFs at the start of this year. They have now reversed, and we're seeing not rapid but steady outflows, particularly from North American ETFs. Again, when I was speaking at the German conference this week, I showed them a chart of the holdings of German ETFs, which have grown over the last decade to become quite important, and they actually haven't fallen this year. It's very much demonstrating that it's a US investor reaction to the weakness that they're seeing in the price of gold in US dollar terms, and expectations for further strength and further dollar strength and further hikes in interest rates. So, you know, gold has done well under the circumstances. Now, in terms of inflation, there's no doubt inflation's at 40-year record highs, I think, in most countries, and certainly around 10% in the UK and quite close to that in the States, I believe. Work we've done and published a couple of years ago shows that gold isn't a great hedge of US CPI. What it's a much better hedge of is expansion in US M2 money supply. And if you look at what happened to M2 back in 2020, when central banks around the world, and particularly the Fed, were carrying out extraordinary measures to protect economies, we saw a huge jump in the money supply, and obviously gold performed really well that year, up 25%. That monetary expansion has slowed dramatically, and together with quantitative tightening, you could argue that actually the amount of money sloshing around the US system is declining rather than increasing at the moment. So I think that's also one of the reasons why gold hasn't performed brilliantly in US dollars this year.
The last time we met, a lot of our discussion was focused on the outperformance of Bitcoin versus gold. And now that Bitcoin is down over 50% on the year, has this helped gold flows at all?
That's an interesting question. It certainly hasn't triggered any noticeable inflows into gold. As I say, you can characterize certainly the last 4 or 5 months of steady outflows from the exchange traded funds and reduced net long positions on the COMEX futures market in New York. In fact, they're running short at the net short at the moment. So no, we can't identify any inflows into gold as a consequence of the weakness in Bitcoin. But then again, we were never able to identify any outflows in gold when Bitcoin was strong. Our experience is that investors understand that these are two very different instruments. And despite marketing from some of the crypto community, all the work we've done has demonstrated that having gold in a portfolio and having Bitcoin in a portfolio ends up doing two very different things. And one is not a substitute for the other. Now, I don't have any formal views on crypto assets. I'm with the World Gold Council. Why would you listen to me when I'm talking about crypto? So I'm not telling people to buy it or not buy it. But what I am saying is just understand what it does to your portfolio. If you own crypto assets, you've added risk to your portfolio. And one of the things that I would say under those circumstances is the best diversifier of that additional risk is to add some more gold to your portfolio as well. Now, we've done a lot of consumer research on this topic. Investors do recognize the difference from what we can see of what you should expect from having gold and what you might expect from having crypto assets. So I don't think they actually compete for each other in flow terms.
You mentioned earlier you were at a conference in Germany. You're all going on the road in the next few weeks, visiting other countries, other conferences. Maybe you can just touch on the feedback that you've gotten from investors at these conferences. And I'm sure you take a lot of calls too from investors, institutional investors, retail investors. Maybe you can just give us a sense of what people are saying.
Well, there's a number of things. The question about why hasn't gold done better is one that comes up a lot. I mean, it's outperformed equities, it's outperformed bonds, and it's gone up in non-US dollar terms, but everybody looks at the gold price in US dollars first and foremost. So I do get that question a lot. I spend a lot of time explaining what's been driving it and what you really should expect from gold under the current circumstances. But aside from, shall we say, the short-term direction of gold, we're getting a lot of inquiries from institutional investors and advisors about strategic allocations for gold. These are institutions or organizations that we've been speaking to for a number of years, and the conversation is a long one because we're talking about making a long-term investment at a strategic level. And I've been really pleasantly surprised by how those conversations have continued this year, despite the fact that dollar gold price is down. Look, we're nowhere near at a position yet where every institutional investor or every advisor is recommending an allocation to gold, but the direction of travel has been really encouraging this year, and I think that's only going to continue. So, I mean, I've visited the United States, Australia, Singapore, India, and as I said, Germany, all in the past 6 weeks, and I'm actually off to New York again tomorrow. Sunday. And we're having a lot of really interesting conversations, and I think that we're making the case aggressively and enthusiastically why gold should be in your portfolio. And I think this is having an impact in terms of demand, potentially for demand that we're not able to track necessarily if it's going through the over-the-counter market. And I think the long-term impact of this will be manifest.
John, as we wrap up, you've already touched on a lot of the benefits of holding gold, but maybe you can just summarize for our viewers why they should own gold in their investment portfolios. What are the benefits to holding gold?
I mean, it's a very simple argument, and I give this around the world in different currencies and compared to different local assets, and the story is always the same. People think gold is an asset that does well during crises or coronavirus pandemics or unexpected geopolitical tensions, and that's correct, it usually does, but it's more than that. Now, since 1971, or over the last 20 years, or over the last 10 and 5 years, it's delivered returns that have been in line with or better than most other asset classes. So it's a source of returns, not just for the bad times, but for all the times. I think the second thing is diversification. I think most people know that gold helps diversify your portfolio because it's not correlated particularly to equities or other things with equity-like risk return. But what we find is if you look at what happens to gold's correlation to equities, it does move around. So when equities are rising rapidly, gold's modestly positively correlated to equities, which is obviously positive. When gold falls sharply, though, that correlation falls away and in some cases flips negative, so that you can now be either uncorrelated or even negatively correlated to a rapidly declining gold market. So that's diversification that really works well when you need it the most. So if you look at the performance of gold during crises and financial events over the last 20, 30 years, gold's generally done well during those periods when other assets are doing poorly. So you put those factors together, returns, diversification that works, particularly when you really need it, and some protection to your portfolio from black swan events, or however you want to describe them, and having an appropriate weighting for gold increases your risk-adjusted return of your portfolio, kind of the holy grail for portfolio investing. Now, the final thing, what's the right amount of gold in your portfolio? There is no one single answer to that because it depends what's in the rest of your portfolio, depends what country you're in, depends what time period you're examining it over. But what we generally find is that for every portfolio we look at, pretty much all of the optimum allocations to gold come in between 4% and 10%. And generally speaking, the more equity risk or equity-like risk you have in your portfolio, the higher the target allocation to gold. The more fixed income you have in your portfolio, the lower target allocation to gold, because gold's a better diversifier of equity risk than it is of fixed income risk. That really, in summary, is what we say to investors. That's the strategic case for gold.
Well, John, that was a great overview of the World Gold Council and also the benefits of holding gold. And I want to thank you for sharing your thoughts with us today. I would encourage all of our viewers to check out the World Gold Council's website, gold.org. It has a wealth of information on there pertaining to anything and everything to do with gold. John, once again, thank you.
Thank you very much.